DSCR loans are designed for stable income-producing rental properties. Hard money loans are short-term and typically used for distressed properties that need rehab, like fix and flips. Hard money loans also come with higher rates and interest-only payments, while DSCR loans offer longer terms and lower rates.
Can you live in a property financed with a DSCR loan?
No, DSCR loans are only for investment properties. The borrowers must use the property for rental income and cannot live in it or allow close family members to occupy it. For properties used as a short-term rental, such as Airbnb, for example, owners can only stay in the property no more than 14 days per year if financed with a DSCR loan.
What is the definition of a DSCR loan?
DSCR loans are mortgage loans secured by residential real estate turnkey properties strictly used for a business purpose and underwritten primarily based on the property. Are you a real estate investor tired of getting denied by conventional bank limits, but not desperate enough to pay the massive fees of a hard money loan? There's a secret middle ground that is helping investors scale massive rental portfolios, and it's called a DSCR loan. If you want to build real wealth in real estate, you need this tool in your tool belt.
What is a DSCR loan and how does a DSCR loan work?
A DSCR loan is a type of mortgage loan designed for real estate investors where the underwriting is based primarily on the income-generating potential of the property rather than the borrower's personal income. Essentially, these loans are a financing solution that offer more flexibility and easier qualification than constraining conventional options while still featuring competitive rates and terms that are much closer in conventional counterparts than last resort options from loan sharks or hard money lenders. Designed with common sense, DSCR loans offer investors a much needed middle option with reasonable documentation requirements, low enough rates, and long enough terms to make deals work. DSCR loans are a Goldilocks loan type that have the perfect mix of qualification case and attractive terms. They are accessible to most real estate investors and aspiring investors. Thanks to the existence of DSCR loans, successfully financing rental properties is no longer restricted to those with high enough personal incomes and tolerance for mountains of documentation paperwork or people desperate enough to pay predatory rates and sky-high fees of hard money. Before we break down the definition, if you're finding this helpful, make sure to hit that subscribe button. And be sure to check the description below for a link to our full DSCR loans guide for even more details. Now let's look at the definition of a DSCR loan. DSCR loans are defined as mortgage loans secured by residential real estate turnkey properties strictly used for a business purpose and underwritten primarily based on the property. Each aspect of this DSCR loan definition is purposeful and important. Let's address each piece and why it's important for understanding DSCR loans, the emerging leading loan option for rental property investing. 1. DSCR loans are mortgage loans. DSCR loans are loans that are secured by real estate, that is, the real estate itself serves as collateral for the loan. This means that if a borrower defaults on the loan, i.e. doesn't pay the required debt service payments, then the lender or the owner of the loan can foreclose on the real estate property and take over ownership of the asset. Mortgage loans are secured loans in which the collateral is real estate. Other examples of secured loans are auto loans secured by a vehicle, or even loans secured by assets like Bitcoin. Unsecured loans are loans in which if the borrower defaults, the lender can't take ownership of any collateral asset. Examples of unsecured loans include debt such as student loans or credit cards. Since there is no collateral for the lender to take in case things go wrong, interest rates on unsecured loans tend to be higher than secured loans. 2. DSCR loans are secured by residential real estate. The collateral for DSCR loans is a specific type of real estate. In this case, properties that are residential in nature, usages for living, and not commercial, such as usages for business or commerce. Sometimes people get confused and think that commercial real estate lenders, such as lenders that lend on commercial real estate like office or industrial properties, offer DSCR loans. But those loans are different loan type with a very different qualification standards and attributes. Since CRE lenders often use the DSCR ratio for qualification and underwriting, this can be confusing for many when just learning about financing options. Luckily, the video you are watching goes over everything you need to know about DSCR loans and clears these confusions. A final note. As is common across real estate, there are exceptions to nearly every rule and many terms that can be confusing. And this aspect of the DSCR loan definition is a good example of this phenomenon. When DSCR loans are described as being for residential real estate, This typically means residential properties between 1 and 4 units, while anything with 5 or more is considered multifamily and is typically considered separate from both residential, 1 to 4 units, and commercial, such as properties where people go to work. Additionally, in recent years, some DSCR lenders are now offering DSCR loans for multifamily properties, generally 5 to 10 units or even mixed use, mostly residential properties with some commercial space. DSCR loans are also a top option for short-term rentals, where tenancy is better classified as short stays rather than full-time residential living as the use. However, these properties are typically financed by residential DSCR lenders rather than commercial hotel lenders. 3. DSCR loans are for turnkey properties. In real estate, the term turnkey refers to properties that don't need any renovations or repairs in order for someone to move in. The idea is that all the work that's needed is to turn the key, and the tenant is good to go. A key aspect of DSCR loans is that the properties must be turnkey with no major repairs needed. Generally, most DSCR lenders will require the appraisal to show less than $2,000 of deferred maintenance or only very minor repairs that wouldn't preclude living there. Sometimes, investors who utilize real estate investing strategies such as fixing and flipping will finance these purchases. However, loans for these scenarios are referred to as hard money loans, and if the property needs any significant repairs, it won't be eligible for a DSCR loan. This can confuse some investors since there are many private lenders that offer both DSCR loans and hard money loans. So the key takeaway to remember is that for DSCR loans, you need a turnkey property. If it needs work, you should probably investigate hard money loan options. FAQ break.
How do DSCR loans compare to hard money loans?
DSCR loans are designed for stable income-producing rental properties. Hard money loans are short-term and typically used for distressed properties that need rehab, like fix and flips. Hard money loans also come with higher rates and interest-only payments, while DSCR loans offer longer terms and lower rates. By the way, if you already have a turnkey property locked up and you're ready to get funded today, check out the link in our description to access our 10-minute web application at harpooncapital.com. Back to our DSCR loan definition. 4. DSCR loans must be used for a business purpose. One of the most important aspects of DSCR loans is that the loan must be used for a business purpose. In non-technical terms, this means that the property must strictly be used as an investment property, not occupied by the owner or any close relatives. Lenders are very strict on this point, and many steps are taken in the qualification and underwriting process to confirm it's being used as an income-producing property, as there are potentially very serious consequences for DSCR loan occupancy fraud. The DSCR loan business purpose rule even applies to cash out refinances, where even cash out proceeds must be used for a business purpose too, such as buying more real estate or even funding unrelated businesses, and cannot be used for personal reasons, such as paying personal income taxes or going on vacation. Let's pause for another FAQ.
Can I live in a property financed with a DSCR loan?
No, DSCR loans are only for investment properties. The borrower must use the property for rental income and cannot live in it or allow close family members to occupy it. For properties used as a short-term rental like an Airbnb, generally the owner, if financing the STR with a DSCR loan, can stay in the property up to 14 days per year without violating business purpose occupancy rules, according to most lender interpretations. And back to the final part of our definition, Part 5. DSCR loans are underwritten primarily based on the property. The last important, but very important aspect of the definition of DSCR loans is that the qualification is based primarily, but not only, on the property that secures the loan. This is the opposite of qualification for conventional or other non-QM loan options. Those are based mostly on the individual borrower and less on the property. A key differentiator of DSCR loans is that the DTI ratio, or a comparison of the borrower's personal income and total living expenses, is not taken into account, which allows DSCR lenders to qualify loans for income-producing properties that simply make sense as an investment, even if the borrower doesn't have a stable day job, typically requiring W-2 employment for 2 years, or other issues with DTI. However, it's critical to note that DSCR lenders do take some aspects of the individual borrower into account for qualification, including credit score and liquid asset reserves. These affect qualification too, with the key takeaway that DSCR loan qualification is based primarily on the property, but not completely. One persistent myth that has confused investors is thinking that DSCR loans are asset-based loans or similar to the notorious ninja loans or no-doc loans. However, these are misconceptions, as qualification for a DSCR loan does include some aspects related to the individual borrower, credit and liquid assets, and there is plenty of documentation. True asset-based loans that are completely based on the property are not DSCR loans and also fall into the broad category of hard money. And there you have it, the complete breakdown of how a DSCR loan works. While they are an amazing tool, every real estate journey has its hurdles. If you want to learn how to navigate them like a pro, head over to harpooncapital.com and fill out our Contact Us form. When you do, we'll send you our completely free ebook, 10 Obstacles for DSCR Loans and How to Overcome Them. Don't forget to like this video, subscribe to our channel, and check out the description for all the links we mentioned today. Happy investing, and we'll see you in the next video.